We're down over 16%.
Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Two-year no yields went from
To answer this question, we will take a closer look at the yield curve. The yield curve compares interest rates on short-term and long-term government bonds. Under normal circumstances, long-term bonds pay higher yields than short-term bonds, reflecting the greater uncertainty over time. But when the yield curve inverts, meaning short-term rate rises above long-term rates, it often signals that investors expect economic trouble ahead. This isn't just theory, history also backs it up. Before the recession that followed the dot-com bubble in 2001, the yield curve inverted, warning of the downturn to come. And in 2007 it inverted once again, just months before the 2008 financial crisis devastated global markets. Today we are seeing a similar pattern emerge. The yield curve is currently deeply inverted, a sign that could point to another significant economic slowdown. While no single indicator can guarantee a recession, the yield curve consistent track record should make us pay attention to the warnings it's sending. But the yield curve is only part of the story. To gain further insights, let's look at another reliable indicator, the Sahm Rule. This rule is activated when the 3-month average unemployment rate rises at least half a percentage point above its low from the previous year. In other words, it detects when the job market is weakening rapidly, a clear sign that economic conditions are turning sour. Historically, the Sahm Rule has been a precise early warning. Before the 2008 financial crisis, it flashed red as unemployment began to climb, confirming that trouble was on the horizon. Each time it has triggered, a recession soon followed, making it one of the more accurate signals of the broad economic downturns. Today, the unemployment remains relatively low, but if we see that half-point increase in the coming months, it will mirror the pattern we saw in the past. If that happens, the Sahm Rule would be reinforcing the message from the yield curve, that we are potentially heading down a similar path to previous economic declines. Another key piece of the puzzle is the Buffett Indicator, named after the famous investor Warren Buffett. This metric compares the total value of the US stock market to the nation's GDP. Historically, when this ratio climbs well above 100%, it signals that stocks may be overpriced relative to the real economy. Consider what happened before the dot-com bubble burst in 2001 and also ahead of the 2008 financial crisis. The Buffett indicator soared to alarmingly high levels, reflecting a market detached from the underlying economic fundamentals. Each time, overvaluation eventually corrected in painful ways. Also today, we are once again seeing the Buffett indicator hover at historically elevated levels, suggesting that the stock market might be running too hot. While this of course doesn't guarantee a crash, it mirrors the same kind of warning we saw in past market tops. An overextended market that could be vulnerable if economic conditions take a turn for the worse. Corporate insiders such as executives and board members often have the best grasp on their company's true health and future prospects. Their buying and selling decisions can serve as a valuable signal for where the market might be heading. When insiders increase their selling activity, it suggests they may foresee challenges ahead. So perhaps a declining profits or tighter margins or broader economic headwinds. This pattern appeared before the 2001 dot-com bust and also the 2008 financial crisis, when insider selling spiked ahead of major market downturns. It's as if those in the know were quietly stepping back, reducing their exposure before the broader market caught on. Today we are seeing elevated levels of insider selling once again. While these actions alone don't guarantee a crisis, they do mirror the same cautious stance insiders took before past economic slumps. adding yet another piece to the puzzle that points toward a potentially turbulent period ahead. The Fear and Greed Index looks at how people feel about the market. It checks things like how fast prices are moving, how steady the market is, and whether investors are going after risky stocks. When the index leans toward greed, it means investors are very confident, maybe too confident. When it swings toward fear, it means they are getting nervous and pulling back. In the past, we have seen then that when everyone is too optimistic, like before the 2001 dot-com crash, they tend to ignore dangers. Similar to before the 2008 financial crisis, many investors kept taking risk even though the warning signs were there. Today, if the index shows a lot of greed, it might mean we are repeating the same mistake, chasing fast profits without seeing the dangers ahead. On the other hand, if it suddenly shifts to fear, it could mean the market senses trouble and is preparing for a downturn. In either case, if we are seeing the same extremes as in the past, we might be heading toward another big correction. But in the end, I also have to say that none of these indicators can predict the future with 100% certainty. And this is also not financial advice. I'm simply sharing the patterns I've noticed and also the signals that have flashed before previous market downturns. While we can't be sure that history will repeat itself exactly like that, it's clear that caution is warranted. Personally, I plan to save more cash, so I'm better prepared if the market does take a sharp turn. But in the end, it's about staying informed, managing risk, and also making decisions that fit your own situation. Because no one truly knows what tomorrow will bring.